Two, one, and we are live. So, welcome everybody to a new week filled with opportunities in the markets and really clean serves, as you'll see later in the fourth part of this video. So, today, I actually had the intention of doing a three-part series covering higher time frame analysis and basically, so this is the first video on the three-part series, and I know I've actually talked about IPD ADR ranges, but I still feel that many of you don't still really have an understanding of what IPD data ranges are, now to utilize them. And today, I'm going to be clarifying everything. So before I proceed, I want everyone, if you have questions, if you watch my videos, you have questions, please don't send me DMs on Telegram because I have so many DMs from lots of people. So yours might get lost. And this is why oftentimes I usually find it difficult to get back to each of you because it's very hard trying to filter out who is DMing me when there's like 100 to 150 people sending me texts or messages every single day on Telegram. So the way you do it is you tag me on the chats. This is why the chats are there. The Forex Cartel chat is there. So you tag on the chat. I'm going to see the message and I'm going to reply back. Okay? If you do it that way I don't miss your messages, and also that way I can quickly answer your question. So if you have any question, please stop asking the educators for one-on-one, or stop trying to stop asking me for one-on-one basically, because you're asking me for one-on-one. Also, 30 other people from the group is asking for one-on-ones. So I can't just spend my entire day only one-on-one webinars for every individual person because Genie is so free. Genie has a lot of time. We can know one-on-one people. Okay, so you also gotta respect my time also. So this is why I take effort to do all these videos, everything. Okay, so now if you have questions or you don't understand anything on the videos, then you make sure you attend the weekly live sessions with the educators. Okay, so you write that question down, and then you attend a weekly live session and ask them those questions live on the webinar, and then you're going to answer that for you. Okay, so this is the way you do everything, and everything on the chat becomes organized, becomes structured. Because if you're DMing Bailey, you're DMing Norway, you're DMing Matthew, you're DMing me, you need one-on-ones, you have sets of questions that it gets really difficult when there's like 30 other people from the group doing exactly the same thing. So how are we going to split time to basically do one-on-ones with 30 other people trying to answer their questions, right? So this is why when you have questions, write them down. Just basically webinars every weekday. Okay, so you can ask if you can attend either Monday, or if you miss Monday, Tuesday, Wednesday, Thursday, Friday. Sorry, okay? So you can ask any of the educator on there. This is the issue I'm having. Jean talked about this. I don't really understand what Jean talked about. Can you shed some light on this? Can you explain this? And they would not hesitate to answer your question. Okay, so please, you also have to respect and value my time. You also have to respect and value the time of the educators also, because if we're trying to do one-on-one with every single person, things will not just work that way. Okay, it's also effective you asking questions on live webinars, because it's the same as you doing one-on-ones. The person is going to explain that to you. Okay, so please going forward from here, I want everyone to follow this order, to follow the structure. When you want to ask questions, when you don't understand things, make sure you tag the educators in the chat, and then they're going, their attention is going to be drawn to that text. Okay, and then during one of the live webinars, you can ask them that question. Or if the educator decides he wants to do a one-on-one webinar with you, then that's cool. Otherwise, please don't bother them, because you're getting same messages from the other people in the chat, and it's really tough for them when you're trying to hold webinars for about 20-25 people each day texting them. Okay, so please reconsider it. Please also value the time of these people and myself also, and going forward from there. All right, so we're going to out of the way. let's go into today's schedule, which is the first video in our three-part series is the IPD data ranges. And even though some of you are familiar with one of us right now, I still feel I need to shed some light on this to clarify some aspects for those who are finding it difficult to understand, to clarify what they do. So first off, I'm going to start with higher time frame analysis. Okay, so if you go online, you go to Instagram, you see a lot of Instagram mentors, a lot of people with fancy cars, take flies, all this kind of stuff, which trade institutional. So nowadays, trading, being an institutional trader is kind of like the trend to a lot of people. Okay, so schools call yourself an institutional trader. So many people, to them, institutional trading is order block, equalize, equals, that is everything. You don't know how to use seasonal tendencies, you don't understand IPA data ranges, you don't understand higher time frame analysis. All this is all neglecting. This is why these people actually lack the value to give out to you people. Okay. And this is why, even though you see them trade institutional, you're still losing money. Some of them, even though they don't show it, you're still blowing accounts. Why? Because you're not taking the time to learn. Okay. And you're basically taking free stuff, ICT drops on YouTube, and you're kind of that institutional analysis. All these ones are all your bullshit, your crap. Okay. The real stuff is what I'm going to start teaching you guys, which starts with the higher time frame analysis. So let's go with a lot of you guys are having issues with higher time frame analysis, and that is what we're going to cover today. Now, what is the benefit of having a solid higher time frame analysis? Okay, the thing is, you're never going to get surprised by any quick move in the market. Okay, you're going to know beforehand when price would range. When I say range, I'm talking about small, very small ranges. Because you're going to know beforehand, looking at the higher time frames, when price is going to range, where to stay, when to stay away from trading, and what levels you can expect explosive moves. So a lot of people think what you need to focus on is the 1 hour, 15 minutes, basically the small time frame. This is what you need to focus on to get your explosive move. This is all wrong. This is all this is a bullcrap. Okay, it don't work. You're gonna get an explosive move. You're going to reference the higher time frame. So you're going to look at price from the higher time frame standpoint. Now the reason why is because the people actually moving the market use these time frames to base your orders in the market or to place orders in the market. Okay, these people have huge amounts of money, contracts. So these people are placing blocks of orders. You're not like we retail traders who place one lot size, 10 standard lot sizes. These people are placing 1 million, 2 million. So we call these blocks of contracts. Okay, you're placing block of contracts in the market to move the market. And the time frame these people are referencing is the higher time frame, basically the monthly, the weekly, and the daily, due to the sheer volume of their capital. Okay, and this is why it's very key to have a solid higher time frame standpoint in the market, because that way you know when the explosive moves are going to come. You know what the market is going to do. You know what levels the market is trying to reach for, and you can all use this to your advantage, and you never get caught out, never get surprised. The market never does anything. You know beforehand. Okay, this is why it's essential to have solid training on higher time frame analysis and viewpoint. So with that being said, let's go to IPDA data ranges. So what is the full meaning of IPDA? IPDA simply stands for interbank price delivery algorithm. Okay, so that is the full meaning of IPDA. Bank price delivery algorithm. What it simply means is, if you look at the higher time frame levels, okay, so the question you want to ask is what drives price? We know that the central banks, who are the caretakers of currency, are the ones actually pushing price around the marketplace. So you're creating environments for every other entity or players in the market speculating. So when I say players in the market, I'm talking about we as retail traders, the company actually doing real-time international transactions, people importing and exporting via the country's currencies. So all this kind of stuff, the people regulate this market to facilitate all that kind of different, to cover all the entire spectrum of trading, speculating in the forex market are the central banks. And if you look at the market, it's too vast for humans to basically efficiently move price because there's huge players in the marketplace. There's different blocks of orders, contracts coming into the marketplace every given second. That is just so much information for humans. Even basically the flow of traders, that is just way too much information for these people to handle. Okay, and the efficient way we as humans have figured out how to do complex tasks easily and quicker is by using computer and using softwares. Okay, so computers change the game for the world. The internet changed the game for the world. Okay, so now what is actually used to move price around efficiently is the interbank price delivery algorithm. So this is moving price around efficiently in the marketplace. So the sole purpose of the interbank price delivery algorithm, which stands for IPDA, is to seek liquidity. So now, the sole purpose of the IPDA is to seek liquidity and to seek efficiency. So this is where price is always trying to reach for on the higher time frame levels. Price is always trying to reach for areas where price action was inefficiently traded or areas where a level of stops or liquidity will rest around that region. This is what IPDA does. And IPDA is basically like a software. This is why we call this price delivery algorithm. Just look at the last one, A. Algorithm meaning is the software. It's a program driving price around, seeking for liquidity, making sure that it's trading the environment for every other single player in the marketplace to speculate in. It's actually going to advantageous us as traders to know where IPDA is trying to reach for. So now, the next question is, how do we know where IPDA is reaching for? Where do we think IPDA is trying to reach for? Because it's one thing to understand all the theories. It's one thing to know what IPDA does. It's another thing to actually apply that in real time to your charts. Okay, so now just like every other software that will be developed for a computer program, okay, there needs to be data that the software can draw from or reference, okay, to make efficient calculations what it should do next. So IPDA is basically like a program needing to make calculations what it needs to do next efficiently. Just like all computer programs, IPDA has to deal efficiently. And for IPDA to do that, it needs to draw data from somewhere to know what calculations it needs to make next. And IPDA is going to draw data from previous price action. Okay, so what IPDA is going to do is IPDA is going to reference previous price action and then make decisions based off what is referencing from those previous price action to move price around going into the future. Okay, so what IPDA basically does in terms of reference is referencing the 60 days. So let's do this real quick. All right, so there's two phases to IPDA. The way IPDA moves prices around. So IPDA needs to look at the past, previous data to draw reference from, and then IPDA has to start making calculations going into the future where it needs to move. Okay. So the process of IPDA looking at price from the past is what we call the look back phase. All credits going to Michael J. Huddleston, which is the actual creator of ICT. This is term look back phase. Look back phase simply is the phase where IPDA has to reference previous price action, make conclusions, or to draw references from previous price action. And what IPDA will typically do, okay, Now, note that word typically. So what IPDA is going to simply do is reference 60 days back, the range of, sorry, in a range of 20 days to 40 days to 60 days. Okay. So what IPDA would then do is to seek institutional reference points from those levels. So IPDA is going to seek institutional reference point in the last 20 days, then the last 40 days, then the last 60 days, and then try to move price to the least traded reference point or the reference point that has the most liquidity around that level. So I want you guys to take note of what I just stated. So IPDA is going to look back, which is what we call the look back phase. IPDA is going to look back 20 days, then 40 days, and 60 days to look for where the institutional levels are. And now, note that when we're doing this on higher time frame. Why? Because this is the time frame the banks and institutions are referencing to place orders or to base trades off of. So you want to do what the banks or the institutions are also doing. Okay, and then the banks, the benefit to the banks is they know beforehand where IPDA is trying to move price to. What we're trying to do is we're trying to deduce what IPDA is trying to do so that we can trade in sync with what IPDA is trying to do. And the only way you can do that is to first reference institutional reference point in the last 20 days to the last 40 days to the last 60 days. Okay, so when I say institutional reference point, I know definitely someone's going to ask me, so Gene, what do you mean by institutional reference point? Institutional reference points are all, I want you guys to take this down. Let's see. Points. So let's make this italics. All right, so institutional reference points are the points where you can spot institutional price delivery around those points. So now, what do I mean by institutional reference point? So a fair value gap is an institutional reference point. An order block is an institutional reference point. Okay. A breaker, meaning a mitigation block, is an institutional reference point. Old highs is going to be liquidity resting around old highs, and old lows are institutional reference points. So all these are the institutional reference points you want to reference to when you're looking at IPDA, because price is going to try to seek one of those levels. IPDA is going to try to drive price to one of those levels. Okay, so let me reference my note real quick. Let's see. All right, so so what you're trying to do is you're trying to work the way the interbank algo works by casting back 60 days to find reference point. Okay, so what you're trying to do is to go back 60 days, find the reference point, and the reference point are simply all the things we talk about institutionally. Okay, old highs, old lows, mitigation block, okay, fair value gaps, other blocks, rejection blocks. Those are the 5 institutional reference points you want to be looking at. Okay, because price is going to try to reach for those levels. Okay, so the essence of doing the look back phase is to determine where price is trying to reach for based on the liquidity or the inefficiency in price. I want you guys to know that price is going to try to seek for these levels based on the liquidity or inefficiency in price before it then moves away. All right, so this is what we're doing on the look back phase. We're trying to mimic what IPDA does by referencing institutional points in the last 20 days, the last 40 days, the last 60 days, and drawing analysis from those reference points. Then the next phase is the cast forward phase. Okay, so I'm gonna write this out real quick. And by the way, guys, do not worry. I'm going to show you examples on the chart so that you guys can do your own work too. So please just be patient. So we have the look back phase in a range of 20 days to 40 days to 60 days. Okay, the deal now. The reason why we're doing 20, 40, 60 is we're using the concept of quarterly shifts in price. So if you go to your daily time frame and you look at you divide each trading year into like a space of 3 to 4 months. Okay, you're going to see that every 3 or 4 months there was a shift in price. Okay, there's something that turned price around every 3 4 months. You're going to see that every year in all currency pairs, all asset classes. Okay, this is what we call quarterly shift in price. Quarterly shift in price is when in a certain quarter of the year, okay, there's going to be a flock of institutional activity around an asset class is going to cause a major move in that asset class. This is what causes quarterly shifts in price. Okay, so we just had a quarterly shift on Euro USD and Pound USD from the 1st of January. So from the 1st of January, we had a bearish quarterly shift on Euro USD and the Pound USD. So you can simply do that by going back to your charts. You're going to see that there. So now, why was price bearish? Because the institutions came in and moved the market to the downside. Okay, and if you look at a quarter, basically is 3 month period. Okay, so a quarter is basically like a 3 month period, and this is why we're using a range of 3 months to reference price, because we're trying to look for the quarterly shifts, okay, on the higher time frames to get swing trading opportunities, to get short-term trading opportunities, and definitely to get day trading opportunities too. Because if you know what direction the market is trying to move towards, then you can day trade in line with that direction, because that is going to be your highest probability of price moving in your favor. Okay, so there's a look back phase, 20, 40, 60 days, which is basically a 3 month period, because every month we have 20 trading days, which is basically all the weekdays every month. So if you do that for 3 months to factor in quarterly shifts, you're doing a 60-day look back. And then your cast forward phase is you're basically what we're trying to do is to mimic what IPD is going to do. So now we've gone and looked back 20 in a range of 20 days, 40 days, 60 days. We've identified all the institutional reference points. Now we're going to do the cast forward phase, whereby we need to decide where price is going to try to reach for. So what reference point could price reach for? Is price trying to reach for the downside? Is there equal lows in form of old lows? Is there negation blocks? Is there other blocks? Is there breakers? Is there fair value gaps in price? Okay. Is there liquidity voids in price? This is all what you want to be referencing to make decisions if price is going to reach for those levels to the upside or to the downside. So this is what the cash forward phase is all about. Then you're going to do this in the range of 20 days cash forward, 40 days cash forward, and 60 days cash forward, because you want to be factoring the quarterly shift in price. Okay, so you're going to do that in the range of 20, 40, 60 days also to make decisions what you expect price to do. So, sorry guys, give me a second real quick. Let's see what's in real quick.